Hey Mugdha, do you use Zomato or Swiggy to order food?
So, Apurva, I use Swiggy more, and especially being in Bangalore, I've been using Swiggy very frequently for the past several years. What about you?
It's sometimes Swiggy, sometimes Zomato. I actually don't have a favorite. But listeners, if you're wondering why we are discussing the two food delivery platforms, it's not because we are hungry. It's because Swiggy is looking to join Zomato on the Boruses. The Bangalore-based food and grocery delivery company made a confidential filing with the market regulator SEBI last week.
Bengaluru-based Swiggy's IPO has been approved by its shareholders.
Food tech giant Swiggy has got the green signal from its shareholders for a $1.2 billion initial public offering.
But can Swiggy take on bigger rival Zomato? And how will investors evaluate the company? That is what we will discuss in this episode with market analyst Karan Taurani of Elara Capital.
In the last 2 years, Zomato has been outperforming Swiggy by a very big margin. So how big is that margin? Because currently we are seeing these numbers only in top line EBITDA and PAT losses or profit, whatever it is.
And Cloud Kitchen brand Ghost Kitchen's founder Karan Tanna.
I feel that it's a great thing for restaurants that Zomato is listed and now Swiggy is going to list, because this will eliminate any kind of short-term practices that any of them used to adopt.
It is Thursday, the 2nd of May. I'm Mugdha Warrior.
And I'm Apurva Mittal. And you're listening to Swiggy versus Zomato, coming soon on stock exchanges, only on the Morning Brief. Swiggy wants to list almost 3 years after Zomato became the first new age unicorn to go public in 2021. The company is looking to raise around 10,400 crore rupees or $1.2 billion. This would entail around 3,700 crore rupees through a fresh issue and up to 6,600 crore rupees as an offer for sale. It's a confidential filing, and so Swiggy's performance and its numbers are not yet public. But Mugdha, tell me one thing. You just did a story on Swiggy. How has it been really faring versus Zomato in the past year?
Yes, Apurva. So Swiggy has lost considerable market share to Zomato in food delivery in recent years, despite being the first to crack the segment. If you remember, Swiggy started food delivery in 2014, while Zomato, which had originally begun as a restaurant discovery platform, had started food delivery a year later. But since then, Zomato has taken a significant lead. If you look at the gross order value or GOV, Zomato has a 54% market share in the food delivery business, and Swiggy has now fallen to 46%. This is as per a recent report from Bernstein. And what could be another concerning factor here for Swiggy is that when it comes to the number of active users and their engagement with both the apps, Swiggy has again fallen behind, and the ratio of the monthly active users on Zomato and on Swiggy now stands at 60 to 40. This is again as per Bernstein. But even data from market intelligence firm Sensor Tower on the downloads and the monthly active users shows a very similar trend. For example, in 2023, Zomato saw 41 million new downloads, whereas Swiggy saw a little under 30 million downloads.
So things aren't looking that great for Swiggy, it seems, on all the key metrics. Let's hear from our first guest, Karan Tanna, who is the owner of cloud kitchen startup Ghost Kitchen. He has closely worked with both Swiggy and Zomato over the last few years. With him, we discussed the changes he has observed with both the companies. So, can you specifically talk about coming to Swiggy? How has your brand's relationship with the company changed? And, in terms of how have their policy changed in the last 2 years ever since they solidified their plans to list in India?
So, Swiggy, so to say, was always relatively a rigid player compared to Zomato. Zomato works a lot on relationships. They have flexibilities, they have exceptions. Whereas with Swiggy, it's pretty standardized and, so to say, monotonous relationships that most of the brands have. Their relationships are purely driven out of the unit economics that they have with those brands. Before 2 years, it was more about how to grow together, how to acquire a better market share for themselves against Zomato. But now it's more about how much more money can they make per order from that brand. So having said that, they do care about market share, they do care about growing a brand, but have a very limited set of tools or exceptions that they are able to implement in order to do so.
Okay, just two follow-up questions. When you say driven out of unit economics, what do you specifically mean? Because even for Zomato, their focus has been on profitability.
Swiggy and Zomato on certain amount of fee from every order. There is a commission that they charge. Then they charge customers some amount of delivery fee or now a convenience fee also. Then the restaurant or a brand does advertisements on their platform. Then in some cases, Zomato and Swiggy also co-fund the discount. So that's a negative cash flow for them for that particular brand. Then there are, gratifications given to customers for wrong orders, for poor orders, which is out of the pocket expense for Swiggy or Zomato. These are the major factors that affect their unit economics with the brand. Of course, Zomato also has a big focus on unit economics. But, as I mentioned, that they have been a little more flexible, a little more growth driven in an interest of mutual growth. It's beneficial that brands does more orders with Zomato and Zomato has a better market share.
So Swiggy's market share has consistently gone down when it comes to food delivery. Why do you think that that's happened?
So, again, circling back to the intent or the drive of improving unit economics. So, discounts are going down. On the other side, commissions for some brands are coming up, and because of which brands are increasing their selling price. Long distance deliveries are being charged sometimes more from customers and then from the brands also. So, all the factors could be a reason that why, customers are buying lesser from Swiggy and more from Zomato.
Got it. What about you're also present in a lot of smaller cities from what I understand, right? Beyond metros.
Yeah.
What
Yeah.
do you have to say about, their strategy in smaller cities? Because Zomato was always had a deeper presence and Swiggy has only recently started focusing on tier 2, tier 3. Do you think that contributes to Swiggy losing market share, that they were sort of late to it?
Well, not really, because, Swiggy and Zomato both are present in 200, 300 cities since a long time. Just that Zomato was maybe present in 500 or 700 cities. But that's a tail end, right? It hardly gave them any volume. And recently, Zomato also shut down operations in hundreds of cities. So
Right.
I think the major volume comes from the big 7, 8 cities or the top 15 cities. So I don't think that that has made any kind of a difference in terms of Swiggy losing the market share.
Arun, now that Swiggy is planning to list, how do you think that will impact the market?
I feel that it's a great thing for restaurants that Zomato is listed and now Swiggy is going to list, because this will eliminate any kind of short term practices that any of them used to adopt in order to grow the food delivery market. Now they will adopt practices which will help to sustain the food delivery market, because now new players who come onto Swiggy and Zomato really have to be upping their game in terms of their operational metrics, in terms of, let's say, kitchen preparation time, rider wait time, reduce the complaints from customers, not keep their products out of stock. Their catalogs have to be very well managed. So, now they really will have to make an effort in order to generate business on or through third party aggregators, because third party aggregators are now focusing on a path which will help them to sustain. So it's a great thing for restaurant that now finally food delivery market will stabilize and will be closer to what realistically it will be when a sustenance phase is attained, which should be in next couple of years.
Karan, could you give us a sense of what is the share of Zomato and Swiggy in terms of your orders? What is the split like?
Well, I wouldn't like to share that for certain confidentiality reasons, but it is skewed towards one aggregator, is what I can say. It was almost between 50-50, 45-55 in 2021-22, but now it's skewed to one aggregator largely up to almost 72 to 73 percentage.
Why do you think this has shifted so heavily towards one aggregator?
In my context, I think it is purely engagement. One of them is engaging very closely with us. Let's say if we are meeting their teams once a week, the others would be engaging with us once a month. The kind of seniority of people that are involved with one aggregator in our business is much better or much higher than the seniority of people in other aggregators.
And internally, how are things at the company, Karan? Do you think they're feeling the heat of the decreased market share?
So, overall, the atmosphere in Swiggy, their teams is also quite confused. They don't have a clear indication or directive that what's their immediate focus. They promise something, but they are not able to abide by it. So they tell us that we are going to take this up with the management. Don't worry, it will be done. But then they get a pushback. So all of this did not happen. Even the city manager level has very limited power now. So the softer decisions that a city manager used to take, for example, if he feels that, oh, there is this brand which people love in Mumbai, so I'd like to give it an exception. That was a decision that a city manager had. But now I think everything is driven by the unit economics.
So that was Ghost Kitchen's experience with the two aggregators and their operations. But when it comes to profitability, Swiggy has still not proven itself, whereas Zomato has seen consecutive quarters of profitability for its food delivery business. In fact, Goldman Sachs in its latest report says Zomato's food delivery EBITDA margin is already the highest among global food delivery platforms.
That's right. And in fact, Apurva, if you remember, Swiggy had said last year that its food delivery business was profitable as of March of 2023. But in the first 9 months of FY24, the food business showed EBITDA losses of 88 crore rupees as per a recent investor note on the company that we accessed. But this is, of course, a significant improvement from the over 1,000 crore rupees EBITDA losses that it had seen in FY23 in the food delivery segment. So even though Swiggy may have seen very minimal losses in the food delivery business in FY24, the company projects that this vertical will be profitable going forward, according to sources who are aware of Swiggy's internal projections. Swiggy also expects the food delivery vertical to grow anywhere between 20 to 25% annually from financial year 2024 to 2026. When we reached out to Swiggy, the company said that it will not comment on numbers and speculations. But I caught up with market analyst Karan Taurani of Elara Capital to discuss how Swiggy has been faring in the food delivery business vis-a-vis Zomato and what the public markets could hold for Swiggy. Karan, thank you so much for joining in on the Morning Brief. And while we're talking about Swiggy and its IPO in this episode, my first question to you actually is on what is the impact that you see on the Zomato stock from Swiggy's potential listing, especially because Zomato is currently the only food delivery company that is listed in the country.
Pleasure to be here. So I think the one big impact is that, investors will have one more option to play with, mutual fund investors in terms of an internet play. If you look at the number of internet plays, Nykaa, Policy Bazaar, Paytm, and there's just a handful of these companies, about 7-8 companies, which operate at a reasonable amount of market cap. Secondly, I think we'll have a mirror here in terms of, performance on a quarterly basis. So as you know, Swiggy was unlisted all this while and one was not able to track metrics. And even right now, if you see, except for the financials, the metrics are not available in public domain. So what it gives to the investors is also some kind of comfort here. So for example, let's say, in the last 2 years, Zomato has been outperforming Swiggy by a very big margin. So how big is that margin? Because currently we're seeing these numbers only in top line EBITDA and PAT losses or profit, whatever it is. But the metrics, in terms of users, transacting users, frequency, it gives a very good bird's eye view in terms of how these companies are performing. And I think third thing is that the valuation multiples for both these companies, could change invariably. Like, so for example, if performance of Swiggy is kind of deteriorating or not improving, you could see the discounts increasing. And if the gap between Zomato and Swiggy's performance increases further, which means that Zomato continues to perform, beyond the margin or rather much better as compared to what they're doing right now versus Swiggy, you could see, Zomato trading at even more premium valuations. So these are three things, in terms of how will Swiggy IPO impact the market and the investor sentiment.
You talked about valuations, Karan, and that's my next question, especially because Zomato is now a bigger player in the food delivery and the quick commerce space compared to Swiggy. What kind of valuation discount do you see Swiggy getting when it lists, given this gap?
So I think, if you look at the numbers, practically when they scaled up, because of the pandemic, and FY 21-22 was the year wherein, they actually scaled up because of COVID. The numbers were largely on par. But what's happened over the last 2 years rather, is that Zomato has seen a massive turnaround. And there are 2-3 reasons for that. One is they've somewhere got this entire growth better. I mean, they are able to, kind of gain market share at the cost of Swiggy. And they've actually become bigger than Swiggy as far as food delivery market share is concerned. That's one. Secondly, I think they've really cracked the code well in terms of, the take rates, the commission rates, the advertising revenue, the kind of levers that they have in terms of revenue growth rate or rather take rate as a percentage of GOV. That has also increased substantially. I think that number was at 15-16%. It's gone up to about 19-20% today. The execution for Zomato seems to be far superior here. Coming to the losses, very surprisingly, both these companies were making EBITDA losses of about 2,500 crores annually for the food business or the consolidated business, roughly. Now, Zomato has turned EBITDA positive on the food business side. The food business EBITDA is, somewhere close to 1,000 crores plus. So the point I'm trying to make here is that execution-wise, Zomato has been far superior on the food business side over the last 6 to 7 quarters. And that's the reason why Zomato food business potentially can get even a 25-30% premium versus Swiggy as far as food business is concerned.
Do you think this is the right time for Swiggy to actually list right now, given that its profitability is still not been proven, given that it has, ceded ground to Zomato over the past year or so? Do you think this is the right time for Swiggy to go public, or should it actually improve its business and its metrics and only then go public? What do you think?
See, it can go either ways. I don't see any problem in terms of, them waiting it out for a few quarters and then come for listing. But let me tell you one thing, even if they come for listing now, and if we see an improving trend in terms of the next 4 or 5 quarters in terms of metrics, the market is going to reward them in terms of valuation multiples. Clearly, the market is kind of very impulsive in that way, in terms of rewarding multiples when the performance is good. So it's either ways. I mean, if they come today, they might come at a 30% discount versus Zomato in terms of valuation for the food business, in terms of valuation multiple, not the size. But broadly, what I'm trying to say is that if the execution is to be in the next 2 quarters, who knows? I mean, they could come to a 10% discount. And the next 4 or 5 quarters, they could be on par with Zomato. There's no doubt about it.
Okay, so that's the food delivery picture. But even when it comes to quick commerce, Zomato's Blinkit has taken a massive lead on Swiggy Instamart. It now has around 35 to 40% market share. And Goldman Sachs has now valued Blinkit at a whopping $13 billion. So it's now bigger than Zomato's food delivery business in terms of valuation. So Mugdha, what do Instamart's numbers look like? I remember Swiggy had earmarked some $700 million to grow this vertical.
That's right. So Swiggy has made significant investment in Instamart. And this business is what may be of concern to investors. Because if you compare it, Zomato's Blinkit is gaining market share while also moving towards profitability. If you remember, Zomato had guided that Blinkit may see EBITDA break even by this quarter itself. On the other hand, Swiggy Instamart doesn't seem to be anywhere close to profitability as of now. In fact, the investor note that I had cited before showed that Instamart had seen revenues of a little under 1,000 crore rupees in the first 9 months of FY24. But its EBITDA losses stood at over 1,000 crore rupees in the same period. And we also understand from sources who are aware of Swiggy's internal projections that Instamart may continue to see at least small losses all the way up until FY26. So that's not a great report card right now.
So why has Swiggy's slice in the quick commerce pie shrunk? And how will the market evaluate this? Mugdha, you asked some of these questions to Karan Taurani of Elara Capital, so let's listen into that conversation.
Karan, on the quick commerce business, Blinkit is now being valued higher than Zomato's food delivery business. And even the growth is going to be faster in quick commerce than in the food delivery segment, right? But when it comes to Swiggy, Instamart, they're still bleeding a lot of money. They're still not close to profitability. So what are your thoughts on Swiggy's execution in the quick commerce space, especially because Instamart has been losing ground not just to Blinkit, but also to Zepto?
Now, on the quick commerce part, what has happened again is that Zomato's execution again has been far superior. You could take it both ways, even in terms of revenue growth, market share, or in terms of profitability. Today, if you talk about market leadership, as per various reports, Blinkit has got somewhere close to 40% market share in the quick commerce side, and Instamart is somewhere close to sub 25%. So I think Instamart is making a reasonable amount of losses, and Blinkit is on the path to break even. See, in the quick commerce space, I think there is not much to differentiate yourself because the kind of products you will sell is very much similar. So 2-3 differentiating points here. One is the product assortment. So basically, you will have certain products, which are doing very well in the market, and you'll probably, stock only those products. The second differentiating factor is, your arrangement with the brands. I think today, quick commerce has got a bargaining power here versus brands, because there are only 3 or 4 platforms, but there are too many brands. Then third thing, of course, would be the customer experience of the app. And lastly, the levers, right? So I think, you need to be present more in terms of products which are high margin nature. So I think there are multiple differentiating factors. The performance shows it all in terms of growth, in terms of profitability. Again, Blinkit here is a clear winner. Now, whether it is the advertising revenue, take rates, better product mix, better inventory assortment. There could be multiple reasons in terms of why this is happening, why a Blinkit is doing better versus Instamart. But whatever it is, the execution is superior. Instamart, they can definitely make a comeback, but a lot of things have to be changed here. Maybe in terms of the product assortment, maybe in terms of customer experience, maybe it could be dealing with brands, because Instamart does have a first mover advantage as far as quick commerce is concerned. And somewhere I think over the last 12 to 18 months, because of Zepto and Blinkit doing well, that is somewhere lost. So they need to get that back on track.
Analysts tell us that Swiggy may be losing out to Zomato due to its stronger execution as well as wider penetration. Zomato has some 750 cities compared to almost 600 for Swiggy. Although Swiggy has been trying to go deeper into non-metro markets. And like you heard both our guests discuss, Zomato has also been sharper in working revenue levers such as ad revenue and loyalty fees, while also more actively engaging with restaurants over the last few years.
When it comes to valuations, Swiggy was last valued at $10.7 billion in the funding round it had raised in 2022. Zomato today commands a massive $20 billion market cap. And the investor note on Swiggy that we had cited earlier had estimated that the company's valuation could be at around a 20 to 25% discount to Zomato's. Will public markets think the same? Who knows, we may have another turnaround in the making. But that's all from Apurva and me in this episode. This episode was produced by Surohini Jain, sound editor Rajas Nayak, and executive producers Anirban Chaudhary and Arijit Burman. The Morning Brief drops every Tuesday, Wednesday, Thursday, and Friday. Tune in to ET Play for all audio content. You can also listen to a podcast on all major podcast streaming platforms. Thank you for listening and have a great day ahead. All the external sound clips used in this episode belong to their respective owners. Credits are mentioned in the description.